Hello and welcome everyone to the Capitalmind Podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capitalmind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capitalmind Podcast. In today's episode, we're taking a look at the number of NFOs, or new fund offerings, done by mutual funds over the past year. We're exploring why fund houses choose to launch new schemes, and the answers aren't as obvious as you're probably expecting. We discuss how many schemes a fund house can launch, and how they can launch even more beyond their soft limit. Who benefits the most from these NFOs? Is it the AMC, the customer, or intermediaries like distributors? How distributors and other intermediaries work with fund houses, and how their economics changes with fund size. And finally, if you're not a direct investor, then what sort of intermediary will work best for you, and how do you identify them? So do listen in. Hi Deepak. So you had promised people on Twitter that you were going to get into one of the reasons why there's so many NFOs, I guess, new fund offerings from mutual funds coming out right now. I think that one of the reasons feels fairly obvious. I mean, the market's doing well, people want to invest, there's so many interesting opportunities available. But on the other hand, I at least distinctly remember there was a time not so long ago when SEBI came down really hard on trying to limit the number of schemes there were. Because otherwise you come up and there's like already so many thousands of schemes, I guess, out there. So how on earth in a world where there are already so many thousands of schemes, does it make sense to try and launch one or two more? Isn't it all just a zero-sum game and it doesn't really help with anyone making more money? So over to you. Why are we seeing so many NFOs?
Shray, that's a great question. And, I put this question on Twitter and people are like, oh, there's a one-line answer. Why are you doing a podcast on this? There is a nuance. And, Capitalmind is kind of famous for getting to the nuance of things, right? So we'll kind of try to explain this from a historical perspective. Like, why are there so many schemes is because there used to be also a lot of schemes in the past. India has more mutual fund schemes than stocks, effective mutual fund schemes, because every actual scheme has a regular and direct option. And each of those has a dividend and growth option. So for every scheme, you have 4 variants, and then there are so many schemes and so on. Now, in 2007 to 2018, mutual funds released a lot of schemes. There was no restriction on the number of schemes that you could have. So Reliance had a Reliance Growth Fund, Reliance Vision Fund, Reliance Equity Fund, Reliance Long-Term Equity Fund, and some Opportunities Fund. So by the end of it, you were like, there are 5 schemes that roughly own the same level of stocks, and one is supposed to own a different set, one is supposed to own a different set, but they can all become the same set of stocks and so on. So somewhere in 2018, SEBI came in and said, listen, this is a bit much. You guys need to calm down. So we're going to categorize funds and say that every fund house needs to have exactly one fund per category. So they said, oh, well, you know what? I'm going to say flexi cap. Do whatever you want. One flexi cap fund that gets to do whatever it wants. Then you get a large cap fund, but then you have to have 80% of your money in the top 100 stocks by market capitalization. Fantastic. That's a large cap fund. That means you can only do 20% outside your territory. Mid cap fund, 65% in mid cap stocks defined by SEBI. Stocks number 101 to 250 and so on. So now if you had a mid cap fund, you could do 65% mid caps and then 35% large caps if you wanted. So it's that's fine. So there was a little layer of flexibility, but not too much. But then there was only one scheme per category. There were about 12 equity categories, 16 debt categories, and then 11 different types of hybrid funds with one fund per category. But some of these categories allowed more than one. You had something called thematic funds and index funds. Index funds, you can have as many as there are indexes. Thematic funds, you can have as many, there can be many themes, right? So you had a bunch of these things. So it was not like it was inflexible, but it was limited in that sense.
Well, limited, look, you said 12 plus 16 plus 11, and some of these subcategories allow for more. So we're already at something between 40 to 50 schemes per fund house without breaking a sweat. So that's enough, right? I mean, why do we need more? I mean,
Yeah, that's a good question. Though to be fair, it is about effectively a similar question could be asked about any asset class where you could have many managers doing things. So the different managers, they may have different styles. They may invest in the same set of stocks, but they may actually choose to have different weights, different timing mechanisms, different entry points for the stocks, and so on. So you want flexible schemes as an AMC because you got these multiple fund managers who are really good, and then you can't offer each of them one scheme, as there's only one scheme to offer as a flexi cap fund. So what's happening right now within the industry is there's a demand within the investment management territory where they're saying, oh, we have many more managers now who can manage funds, but they all want to manage a flexi capish kind of fund because they want to shift to mid caps and the mid caps are good, they want to shift to large caps and the large caps are good, and so on. So mid cap fund restricts you to just mid caps, and therefore you're kind of doing this. I would say the problem here is that because you can have only one flexi cap fund, the industry went on the route and said, listen, dude, what else can we do that sounds like that allows us to behave like flexi cap, but we can then do whatever we want. So the answer is themes. So you would think a theme would be something like a manufacturing theme or something like that, which makes sense. But then there's a theme called a business cycle theme. A business cycle means businesses that have cycles, and honestly, every business has cycles. So technically, you could use this to invest in any business in any which way you want, as long as it overall met the fact that it was in a business cycle. So that would be one. There are other funds like ESG. ESG is just environment, something, and governance or something like that. So technically, even ITC, which makes cigarettes, which technically you would think is bad for pretty much anything in this case, your social and for environment and all that, you'd think that it would rank very low on ESG, but apparently it ranks very high on ESG. So and honestly, Tesla does not rank as high as perhaps some of the oil companies because of the way they
governed, I guess,
or something like that. I guess I don't know which one it is, but the problem with this whole ESG thing is I think it's a bogeyman created so that you could use it as a theme, but then still have another flexi cap fund. So essentially, that was the thought process.
Okay, but it sounds like what people are doing. By the way, on that ESG thing, I think you might still be constrained by the universe of some stocks that exist on some index. But anyway, I take your point. But is this all just an employment exercise or an effort to do training or cater to the needs of, like, you have now too many talented colleagues or too many talented fund managers, and now you have to do something for them, so let's just launch more schemes? In other words, who's benefiting from all this? I mean,
this is a great question, and I think that's the thing that a lot of people look at it from a more simplistic angle. So let me first point out a lot of the wrong answers or partially correct answers, because they may actually be side effects of what the real thing is. We'll come to the real thing as far as I think it is. So some people say, oh, you know what, a new fund gets a 10 rupee NAV, whereas something else is like 30 rupees or 40 rupees. And then you want to tell people that, listen, this is a 10 rupee NAV. It will go from 10 to 20, but that 40 will go only to 50. I think people aren't as foolish anymore, right? Earlier, if you thought about it that way, nobody would buy a stock which is $2,000, and they would be buying stocks which is $200. That's not the answer actually, and that's not why people buy stocks anymore. It's like, if I have $20,000, how much can I buy? Now, but the difference between a 10 and a 30 is not enough for a person who's like investing 2,000 rupees. He's going to roughly get the same number of units, and the units can be fractional. So it doesn't matter what your NAV is. It just matters how much you need to grow, right? So I don't think that's a big deal, and people will Google it easily. The second one, and I think this is real to a certain extent, is there is a marketing angle to this. Everybody likes something new. So if you think of the average distributor going to the customer and saying, sir, do you have something to invest in? Acha, tell me something new. No, so yeah, okay, I have the same old funds that I've told you last year, and they're doing very well. Just put some more money in them. It doesn't sound like fun. Do you have something new? Oh, I have this new ESG manufacturing, I don't know, defense-based railway equipment fund. Oh, we have to buy this, So it's like that part of it becomes a flavor of the year things like that and all that. This just play a role because it helps convert a customer, because everybody likes to participate in the next new thing. So if you told somebody about Bitcoin when it was Bitcoin, very early in that game, people would be like, it's weird and all that stuff. But the minute it started getting popular, everybody's like, can I get some of that? So it's like something is popular, I need to get it. Something is moving. So if the government is talking about defense like crazy, you think every company in defense will do well, or enough companies will do well, and then you say you want to participate. This is not a bad idea in general, but I'm just saying that for people who don't really understand the cycles of this whole thing, it just sounds like something new and shiny that they want to play with. There's also the fact that sometimes you're missing a gap in a product offering. So an AMC may have a flexi cap fund, but you don't have a focused fund, or you don't have a value fund. You want to launch one. And because when you're doing your flexi cap, which is growth oriented or quality oriented, you want a completely different value fund. So people who want to play value, you have a mid cap fund, but you don't have a small cap fund. So you want to complete the portfolio, because if your customer wants to look at your fund house and say, I want to buy everything with you, you should at least have the menu component. It's like if you go to a place that serves masala dosa but no coffee, like at some point you're losing some customers who are saying, dude, this is great, but I want coffee. If immediately after the masala dosa I want coffee. So it's like the guy has to set up a coffee stall, even though it costs him money to set up a coffee stall, and he'll eventually make money on the coffee, but it's a legit reason. But then there is a lot of fund houses that will actually bet on a few funds, saying, listen, this is what we do, and this is what we do best, and you shouldn't have a product portfolio so vast that by the end of the menu card you're almost confused, saying, what did I just see, and what should I, somebody curate this for me now, within the same fund house. It's like if you go to any of the big fund houses, their product offering sheet is like 5 pages deep. Just the categories. You have to go from one category to the other, to the subcategory, to this type of fund, and so on. So I think by and large these reasons are wrong. These are good reasons, but not so compelling enough, because I would say, a fund that's doing very well in one fund can continue to keep pushing that fund out without having to release all sorts of new funds. Fund manager, employment opportunities is not what a mutual fund is for. It's really to do this and so on.
Let me then attempt what people on Twitter told you would be the one-line answer. Isn't this just to make more money somehow?
Yes. So AMCs, they keep thinking, this is the way the AMC is making money. But I think the answer is wrong. The answer is, this is the way the AMC can spend more money.
Normally businesses like to earn money and not spend money. So could you elaborate?
Yeah, so it's interesting because AMC is very restricted in what they can do, right? So there's a very strong structure mandated by SEBI. SEBI says, listen, you take your management fees. That's yours, right? But now if you spend any money marketing a certain fund, the fund itself is a separate entity. The manager is a separate entity, right? So the fund pays the manager. Now the fund may pay the manager 100 rupees. The manager can spend 10 rupees advertising the fund. Then SEBI says, no. Don't do it like this. Let the fund spend 10 rupees and give the fund manager 90 rupees. That means the fund manager should get money post whatever is actually spent on advertising the fund itself. There is a large fee that used to be taken by AMCs earlier, and they would spend from that. But now they say, well, you know what, whatever you're spending specific to a scheme. Now, the 3 big expenses: management fees, of course, like I talked about. There's marketing expenses of the fund itself and, anything that's specific to the fund itself. And then distributor commissions. Distributor commissions are huge because funds that are regular are distributed, and you need to pay a certain fee to every distributor that distributes that fund. Typically, you'll find that a large amount of money goes to distributors. Now, what happens is if the fund's management fee, the TER, the total expense ratio, if you may, were say 2%, and the fund had 1,000 crores, that's 20 crores. Out of that 20 crores, maybe 10 crores has to be given to distributors, so you pay the distributors 10 crores. That goes away as part of the TER. This 2% is the TER. So out of the TER, 10% go to, 10 crores goes to distributors. Maybe 1 or 2 crores goes to marketing expenses. 8 crores goes to the AMC. This is different from earlier, where it used to be like 20 crores would go to the AMC. The AMC would then spend that 20 crore however they wanted. But now, because any expenditure of a fund directly hits the TER, right? So if you spend on the fund, the TR goes up and then you need to take less from it. This is a classic problem in saying the mutual fund houses don't have enough room to spend on their money, the total expense ratio that they're listing off. Now, interestingly, SEBI is also said, listen, you can't keep charging everybody 2%. So as you grow in size, your expenses aren't going up with the same percentage, right? So you need to reduce the overall cost to your fund as the size keeps increasing. For the first 500 crores, you can charge 2.25%. That's about 11 crores, right? The next 250 crores, that's 500 to 750, you can charge only 2% total expense ratio. And then it goes on to 1.75 and 1.6 and so on. So by the time you reach a fund that is, let us say, 2,000 crores, your blended TER is 1.91%. It's not 2.25% anymore. That means blended of all expenses, you can't charge more than 1.91%. This is 1.91% before GST. GST comes on top of this. But 1.91% is chargeable, right? And this is the max chargeable. So direct and regular. Direct charges lesser, regular charges higher. Now, at 20,000 crores, you're at 1.52%. At 70,000 crores, you're at like 1.05, 1.2% or so on. Now, what happens with this is there are two major issues. Firstly, direct charges are nowhere close to this. Because if you look at some of the large funds, 50 basis points or 70, 60 basis points is the direct charge. I'm not looking at index funds and all that. I'm just looking at regular active funds. 50 to 60 basis points is what they charge on direct. The regular, they all charge at the maximum possible rate determined by SEBI. To give you an example, the largest flexi cap in the country is PPFAS flexi cap fund. It's one of the few fund houses that does not have NFOs like crazy. It has only about 5 or 6 funds. This is one of the guys that has actually avoided this problem, but look at how it still has that problem. The direct fund, they charge 0.63%, which is 5.5% plus GST plus a bunch of other things. That means that they earn 0.5%. So for 75,000 crores, 0.5%, assuming that actually about 2/3 of it is direct.
Well, if it was all direct, you'd earn like what? 375 crores.
375 crores. Yeah, but it's not all direct. It's about a little bit less than that. So it's 67%. So on the 33% regular, they pay 1.2%.
Charge.
They charge 1.2%. 1.2% is absolutely the maximum of what is allowed in a fund, in a scheme.
Or at this size.
At this size, yeah. So as they increase even more, there's 1.2% will come down even further. Now, the largest flexi cap in the country is charging the maximum possible TER. You'd think that, is there no economy of scale in this business? But why? And the answer is this. It is the cost of distribution that drives regular plans to be sold. Let's say you're negotiating with a distributor. Now, this is a problem here. It's very complicated. Like, you're a new fund, right? And you go into the distributor and say, listen, I'll give you, I'm going to charge 2.25% for the first 500 crores. So I'm very happy to do that. I will pay you 1.8%. This is not out of the book. This is about how much they pay. They end up paying between 70 to 80% of what they earn as a fee to the distributor. The distributor gets 1.8. I get 0.45. So I am an AMC. I get 0. You're thinking like this and saying, dude, you're paying like 3x or 4x what you're earning to the guy who is bringing you the business. Why? But the answer to that is you can't do it. This is the whole how the industry works. The regular plans typically have very high sharing ratios. So I get 45 basis points. Now you're thinking, why would I get 45 basis points when my direct plan I'm able to charge 60 basis points? The answer is again, because I'm allowing the direct plans to subsidize the regular plans in terms of my fee. But now, if the distributor gets you, say, 50 crores, you're giving them 1.5%. And just to make it simple, 1.5% is what you're giving them and the rest you're keeping. You give them 75 lakh rupees, 1.5% of that. But the fund size keeps growing. The fund hits the 10,000 and 15,000 and 20,000 crore level. Now, suddenly your total blended TER is not allowed to be more than 1.4%. How can you pay 1.5 when you're receiving 1.4? So you're going to go back to the distributor and say, listen, sorry, boss, for every incremental rupee that you bring in, I will give you only 0.75%. The distributor is looking at you and saying, hello, I was getting 1.5. Now you're giving 0.75. I have to do the same work and earn half the money. This is like my salary being cut into half for the same effort. I don't want to do this. So now I think what is driving the driving force of this is that mutual funds are saying, listen, fine, I have a big fund. I know it's doing really well. But why don't I launch a new fund that will allow you to make slightly more money? That allows you to then sell my fund, because otherwise you're refusing to sell my funds and going and selling some other NFOs made by some other AMC. So I'll make a new fund and give it to you. Please go and sell them. Suddenly one manufacturing fund pops up and that fund raises 10,000 crores and everybody's happy because they get that massive 1% or 0.5% in expense that is borne by, I'll talk about who it's borne by. But the interesting part is it allows this distributor to make more. And in this competitive world where your issues of earning are basically, if you give me 50 basis points, I love you. But if he gives me 75 basis points, I love him a little more. You will end up with that. And this is not a bad thing for the distributor or for the industry. And we'll come to that. But I think what happens over here is that the mutual fund itself recognizes, the AMC, that is the asset management company, recognizes that they will make less on the regular fund for the same rupee of AUM than they will make if that fund came that customer came directly to them. But because the distributors take the service cost and the sign-ups and the KYC renewals and all that stuff away from them, they're willing to take a smaller piece of that pie. But also because the distributor committee will not work with you otherwise. It makes sense for them to maximize their income, right?
Fair. I'll make a quick maybe comment is that when direct plans came out, what was it? 2013 or something, right? So over a decade ago, the thinking was that pretty much everyone who would move to direct plans, and the internet was already taking off. But now with the quality of apps we have, with the online transfer limits, you would think that direct is how most mutual funds would want to go, because yeah, sure, I mean there are distributors of course and they add value, but the fact is that with the technology that exists today, can't every mutual fund house pretty much just go direct and get to their customers directly, just do more interesting marketing? In fact, most fund managers like to talk about their books and how they're doing, so do something along those lines and just increase the share of direct every successive year. How come regular still matters so much?
So regular does not matter as much in debt funds and perhaps in index funds, right? So you kind of move that away. But think about the purchasing power or the bargaining power that some of the largest distributors have. HDFC Bank or PhonePe, which does regular now, which does 4 lakh SIPs a month or something like that. The NJ is India's largest distributor platform. A lot of distributors come through NJ. There's an enormous amount of bargaining power that they can bring. Now, many mutual funds are simply run only through a distribution model. They don't have a direct model too much and they don't really bother. They're great fund managers. Their fund managers can impress you with their investing, but their point is, listen, if I have to go direct to customers, that means I have to directly reach all of these people. I don't know how to reach them. How do I get them to this thing? Instead, if the distributor is doing all the work, I don't mind paying them for it. If otherwise I have to hire employees and do that, and the cost of that is much higher. I believe over here that your fund house's strategy will kind of get crystallized early enough, whether you're going to be depending on a distribution model or on a direct model. Now, here's where the problem is. Let's say you're dependent on a distributor model. You can't now push direct because your distributor guys start getting pissed off. They're like, okay, dude, how come if I bring a customer, are you going to go directly to him? I don't want you to do that. So you got to have a Chinese wall between your regular, and that costs money because you got the same sales head, and one of the sales people will be responsible for direct, one of the sales people will respond for regular, and they will hate each other because the direct guy says, hey, on our website we need this feature for auto SIP, and the other guy saying, the regular guy saying, listen, no, if you do all this, my distributor will walk away from me. So this is so look at, for instance, instance, PPFAS, the culture there is to do more direct, and therefore there's 65% direct, 35% regular. So still 35% regular. I'm not saying that this is not this thing. HDFC Flexi Cap has roughly 75%. It's 50,000 crores, and it's about 38,000 crores from regular and the remaining from direct. 75% regular. And most of that, again, must be coming from HDFC Bank as a distributor, right? Their ELSS is 90% regular and 10% direct. So HDFC AMC definitely needs the distribution model to work, and it needs the distributor to make as much money as you want. Now, how do you effectively negotiate with the distributor, right? So you say, you start off with this mechanism saying, I'll pay you 1.7. They took their 1.7. Then your AUM goes up. You can't charge 1.7. So you say, oh, for incremental AUM, I'll give you 1.2 and then 1.1. And sometimes what happens is because you paid the early distributors so much, the new ones, you're getting 75 basis points, 0.75%, 0.6%. Now the guy's looking at you and saying, sir, why will I bring money to you? Because, oh, you may be HDFC Bank, but I have an ICICI something, which is giving me 2% because they're a new fund. So that becomes a problem. So the only thing that they don't want to do is to tell you that you can move your AUM from an HDFC Flexi Cap fund, which has 50,000 crores, to another fund. So they will create distribution mechanisms that penalize movement of AUM from another fund in the same fund house. But if you move it from a different fund house, it's fine, right? So it's like everybody tries to do this in terms of revenue maximization for the distributor. This is why I'm telling you that this is why the AMC is actually spending more money. It's not going to earn more, but it's just trying to retain the distributor. It's trying to make sure that it gets some incremental revenue, but and it's distributor led.
Okay. I hear you completely, and I think I completely appreciate the point that even if a firm like PPFAS with such a strong brand and such good recognition, if even roughly say 1/3 of their, I guess it's either customers or AU, I'm not sure, but if either 1/3 of their customers roughly are coming from regular, clearly it matters, and these people exist, and you have to work with them. So I'm completely with you on that. But this isn't just a question of, say, a mutual fund house and in the distributor ecosystem, if that's the right word, even though I'm sure there's huge variances between them, coming to some sort of mutual decision between them, okay, this is what I'll charge, this is what you'll charge, or I'll do this because I'll scratch your back, you scratch mine. I mean, there's other people involved in this as well. And I was thinking that regulator surely is not thrilled at the prospect that you might be creating schemes where one of the motivations for doing so is to enhance the economics of the people working there rather than to benefit customers, right? I mean, I mean, it has to be a balance between all of these three, but so far the customer doesn't seem to have much of a say in this matter, right? The way you've been talking so far.
Absolutely. I think, the commissions angle of these things is always a dicey issue. And I used to be this, militant person saying you shouldn't pay commissions and all that stuff. And I don't think that's a fair thing because people can't, and we'll come to that perhaps, people can't really do this on their own. If one of the problems that happens in a system where you have distributors is you got to keep the distributors in the business. Otherwise they will go out of the business and then your customers will get left stranded without any service, and it costs a lot of money to do the service, especially in remote areas and so on. So if I were to grow a fund by 10%, because of the incremental AUM getting charged a lot lesser, because, so my blended AUM right now, let's say I'll give you an example, HDFC Flexi Cap, which is our talk about, its blended expense ratio is probably 1.4%. I'm just giving you the highest.
Sure, why not?
So if it increased that AUM by another 10,000 crores, on that subsequent 10,000 crores, it can charge only 1.05% roughly. That means 1.05 for the new, 1.4 for the existing. The blended rate is only actually going to come down. So your revenues don't grow at the same pace as your AUM will grow. So the exact same new AUM, I'm going to make less revenue. This has an impact if you're public. For instance, HDFC AMC is public. So they're going to be like, oh, wait, your AUM went up 30%. How come your revenues went up only 25%? And now, because the distributor share of this income is larger, you're looking at this and saying, no, I'm actually going 20% when the industry is growing 30%. And that hurts you as a shareholder, right? So you're now I've said, okay, the AMC as a company benefits in certain ways. The distributor, this thing benefits in certain ways. Does the customer not benefit or doesn't he benefit? The answer, of course, to give you another problem to this, the customer may not get serviced if there is not enough distributor commissions in this place. And there are a lot of customers that are not being serviced. There's no doubt about that. But I think you have a point in that, yes, higher TERs impact customers to a certain extent. But I'm talking about the difference being 1% or 2%. So, it's not like it's a 15%. Like in insurance, you can see 40% commissions.
Don't you see something like 100%? Or am I making this up?
Yeah, there was
your whole first year's installment is going as a commission or something.
So in comparison with that, this seems like a very weak kind of a commission model.
Yeah.
But in effect, it is, you feel like 1% versus 2% is quite high. And, at size, anyway, a fund's take ratio will actually come down. But let me tell you this other problem that happens. Okay. So let's say I want you to buy this product. I need to advertise this product at some level. Because if the distributor is saying, listen, boss, you're giving me so much, I don't want to buy, I don't want to advertise, you guys do it. So I try to advertise an HDFC FlexiCap fund. Guess what happens? When I advertise the FlexiCap fund, I will actually spend some money. SEBI says that money that you spend on advertising FlexiCap fund has to be borne by the FlexiCap fund itself. So my take rate from there is when I was taking, let us say, I was paying the distributor something and I was getting 0.45%. Now I'm paying the distributor the same thing and I'm spending another 10 basis points on advertising. So I'm getting 0.35%. So I was getting 45 bips. Now I'm getting 35 bips because I spent that money. Guess what happens when I'm a listed entity? I have spent some money. I've increased my AUM. Apart from the fact that SEBI forces me to charge lower AUM TERs, I also have spent on the marketing of this fund. And because I've spent on marketing of this fund, my take rate becomes even lower. So I don't want to advertise the HDFC FlexiCap fund. Now you'll ask me, Deepak, what does this have to do with NFOs? The point about NFOs is there is no fund. So who's going to spend the money? The answer is the SEBI laws allow the AMC to spend how much ever money it wants on the NFO without affecting the fund itself. So earlier, where my TR would increase if I spend something on a fund, right? And then therefore, to offset it, I would have to reduce my take rate. I get to spend as much as I want on a new fund offer because there's no fund that exists. So technically, I could spend 100 crores on advertising a new fund, collect only say 5,000 crores in it. That's 2% of the fund. That would be the entire, TR of the entire fund in the first year. But the fund does not see that expense at all. It's the AMC that pays for it from its own pocket.
But there's the option, right? You could probably put it on the fund as well.
No longer can. Achha. So because in 2006, part of it was allowed. And then in 2006 or 2007, they refused to allow any amortization of any sort. So they said amortization was when you could say, oh, I spent 100 crores. I'll amortize it over 5 years. So every year you spend like 20 crores is removed from the fund as an amortization mechanism that allows the fund to pay for it, but the fund will pay for it over a 5-year period. This was nasty because a fund could spend there was a fund actually, the Reliance something fund, I forget what it was. They collected 5,000 crores in 2007 and they spent 300 crores. That 300 crores was 6%, the maximum allowed expenses that were amortizable, and that was amortized over a period of 5 years. Unfortunately, 2008 happened. That 5,000 crores fell to 1,500 to 1,800 crores because people A, withdrew, and B, the market fell 80%, right? So you ended up with this 300 crores now getting hit on 1,800 crores.
Oh, God.
Right? So you ended up, so because when SEBI saw all this and said, what are you doing? You guys are crazy. No, you're not allowed to amortize any expenses. So now it's gone back to, well, you know what? We won't amortize the expenses, but guess what? I can spend on that fund, but I can't spend on this one because this screws up my economics. So let me spend there. So for me, so I'm coming back to the fact that new NFOs are to allow the AMC to spend. The AMC is a cash cow. It wants to spend. It wants to spend and earn more money, except it's restricted in what can spend in. NFOs allow it that expenditure.
Okay. I think that point is well taken because I think I have appreciated that as an AMC. If you sort of hit scale, you end up making a whole lot of profits and there's not very much you can do with it other than, I guess, send it back to your sponsor and hopefully, I don't know if you have to end up paying taxes while doing that, but send it back to your sponsor.
The sponsor does end up startup pays the taxes if they don't pay their own shareholders down the line. But if they use it, then they have to pay taxes on it.
Okay. I have something to say about what you said, but I have perhaps a more natural progression, which is that, look, the point you just made is that, and this could just be our understanding. No one is obliged to agree with this. But if the issue is that 1% or 2% is not that big a deal, if let's say we are willing to take that stand, then maybe SEBI is sympathetic to this point of view, or SEBI is just a placeholder for anyone who's allowing this to happen in the ecosystem. And so they're like, look, I get it. You're trying to launch new schemes, make them more interesting, bring in new people. So I'm all right with there being some thematic category loophole, or you can go and figure out how to create a new index and then just launch a new product based on that and so on. So in other words, is this like a sort of like implicit, like, yeah, this stuff doesn't matter. It's okay, because in the end, these products are so well governed and their expense ratios are so low that even if one of them is at 1% and the other one's at 2%, frankly, it doesn't matter. Is there some sort of a recognition of this happening, which is allowing people to, go full steam ahead and launch new products?
Yes, I think to an extent, you don't want too many restrictions on a growing sector, right? Because at some level, I think the fact that there are so many funds should not really be a problem. Because would it be okay for you to have only one brand of noodles in your store or two brands of noodles? Because noodles are noodles. How does it matter which noodle you take? But if the answer to that is, listen, they cannot be 45 different brands, types of slightly different Maggi masala with chicken, Maggi masala without chicken, Maggi slightly lesser masala, whatever it is. So that would be one layer, and then the same set of things would come from a different competitor and so on. So imagine that. That's the choice you have, and the choices you have make you weak, right? So there's this, I think we'll talk about that, but I think effectively increase the amount of effort you have to make to just decide on what fund to buy. But let's understand this. If you don't do this, if you don't allow this to happen, you will hurt the growth of the industry, because that's how innovation happens. You have to try something new, and then sometimes that changes the world. Second one is, there is actually going to be products sold in a bull market. When life is good, you're going to get good stuff sold. People get sold clothes in Diwali because people go to buy clothes in Diwali, and people go to buy stocks in a bull market and buy mutual funds in a bull market, and they're going to get sold this. Now, I think if we introduce a lot of legislation that says, SEBI will take a very strong view on what is a theme and what is not. And you go and say, there's a manufacturing fund I want to launch. And suddenly SEBI says, you know what, there's no way we can allow another there are already 40 manufacturing funds. I won't allow you. I think that would make the position of this weak, because at some point, the next fund that could have come would have really performed really well, because it's using some algorithm that is fantastic. And we've just missed the opportunity to get access to that fund, because there were these limitations which were arbitrary at some level. So even SEBI doesn't want that. SEBI is like, listen, I got to create rules that are non-arbitrary. So if I'm going to allow a theme, once I say the theme is allowed, that theme is allowed, and everybody can launch funds in it. So I also think this is a genuine dilemma that SEBI will have, which is, should I stop innovation and therefore curtail everybody into doing exactly certain set of things?
If I can interject, because I'll just make it's not a very good argument, I'll make it anyway for you to respond, which is, if you're saying that, look, choice is good, more variety is helpful, can't we go back to the old time when you were saying back in the day Reliance used to have 5 equity funds that basically did the same thing? So can't you then just allow infinite flexi cap funds as well, if that is truly the holy grail and everyone wants that? But you didn't like that either, right?
I feel that over there, perhaps as a nascent market, you ended up with a lot of magnificent overlap. Now, having seen this side, I am a little more sympathetic to that side, saying, okay, we had a bunch of these, but I think creating a set of categories was fine. Broader set of categories was fine. I think we still have too many, but allowing more innovation within the category, maybe 1 or 2 funds to be launched per category, or multiple funds to be launched per category, because you could have large caps addressed in 2 different ways, but you can have only one large cap fund. So you have to choose as a fund house that I'm going to launch a large cap fund. Then what do? You go and create an ESG fund that invests in large caps, but that does this alternative way of doing things. So maybe there is some room for some innovation over there, but I believe here that at some level you got to understand that this menu creep of funds is a natural phenomenon in any growing industry, because if you start with a place that makes masala dosa, and I don't know why I keep saying masala dosa, I think maybe because
we should order it for lunch and dinner.
But there was a place that does masala dosa, then there's a benne masala dosa, and then Mysore masala dosa, and then something else, and then the idlis and something else, and there are 5 different types of idlis. So eventually guys looking at this menu and saying, dude, I just want masala dosa, what happens now? So there's the waiter will come and say, you want masala dosa? I'll get you masala dosa. This is how the South Indian Darshini eateries operate. I understand you want masala dosa, because if you wanted Mysore masala dosa, you would have said Mysore masala dosa, which I therefore have figured out. We don't have an equivalent, but that's what we're coming down to, which is like, oh, did you not want a manufacturing fund? You just want a flexi cap fund? Just say flexi cap. No, we'll give you flexi cap. We have one flexi cap fund. You don't have to choose multiple types of those flexi cap funds, which is, I think, where the things are coming to. Eventually, what happens? You use performance. And, here's the interesting thing. The new fund officers have no performance. So they have to be sold. The older funds have performance. So you can go to any portal and kind of look at them at some meaningful prime. And you will find that people go and default to the categories that SEBI has created. Say, oh, you know what? I want a bunch of flexi cap or large cap funds. Let me just look at those in terms of performance. And then I rank them all by performance and select maybe the top few, which are done very well on maybe 1 year, 3 year, 5 year kind of periods. And then, this sounds great. But here is what also happens. Now that there's so many tools available, the people who will now say, hey, you know what, there's an ESG fund, and there's a manufacturing fund, and there's a business cycle fund, and there's a flexi cap fund, and there's a dynamic fund. All of them have a 75% overlap in the stocks that they have. What are you going to do with this information? Because you're looking and saying, oh God, this is outrageous. It's 75% overlap. But that was in June 2024. If I look at the July 2024 portfolio, well, 7 of them have 75% overlap, but 8 of them have only 30% overlap because things have changed. So there's no easy answers on this. But I don't think we'll actually protect people by giving them less choice. And there is a famous, I think I wrote this in a letter recently about choices. So it's about this guy, Tom Hanks talking in the initial part of You Got Mail, the movie, where he says, this is, we've made decision making so complicated into something as simple as buying coffee, because you can have a low foam, no foam, low fat, other variants of cappuccinos, and that person feels great just having to make those micro decisions every day, but adds no real value to anybody or life. And to which you had said there was...
I'll say it because I don't want to curse, but I think Rory Sutherland, I don't know why I was on this, but recently had a thing, at a train station, you should probably have a coffee shop that says flat white or F off, so that you don't really have, it takes much less time. But your point is well understood on this, but I do have an issue, which is that can I just bring it back to the customer for a second? You've made a fairly compelling argument as to these are all decent products in the end. Yes, there's overlap, and you can come back to that if you feel the need to. But I still have this sort of like sinking feeling that as a customer, I'm a bit worse off by you making this decision. You being the stand-in for AMC over here, you're launching a new fund that doesn't necessarily solve my problem, but solves other people's problems. Maybe. That's one. But perhaps more than that, I'm sure you'll have a fairly good response to this one. But the other thing is, it was already 40 or 50 funds per fund house. Now I guess it could be even technically 100. So then when I go to, I don't know what Coin or Grow or PhonePe or whoever it is that I go to buy my funds, how on earth am I supposed to figure out what I'm supposed to buy? This is you felt that it was a decent decision because the economics was fine, there's no material loss, or whatever the customer may lose in being marketed a new fund, they will gain because more AUM will go into what is inherently a very good product, the mutual funds. And I'm willing to buy that. I believe in equities myself. But the choice can get overwhelming. So who is the sensible or the kindly waiter who will come and say, masala dosa, I'll handle it for you? Who is going to do that for you over here?
Yeah, this is a great question. Now, this is what the problem is, because finance is a field filled by people who think that finance is so easy that everybody should know it. But anybody outside the financial world is like, God, I will rather cut my right arm off than learn more about this stuff, right? So you need help. We have to understand that help is required. And you know what? And I keep saying this. The more we say that, yes, it is worse off for the customer does have a choice. They can come direct and get a much lower fee. typically half of what your regular fund charges. By the way, the common misconception is if regular is 1.5 and direct is 0.6, then the distributor is getting 0.9. Answer is distributor is getting actually a lot more than that. Most likely getting a lot more than that, because the take rate for an AMC on a regular fund is much lower. Now, keeping that in mind, why is this there, or why is this there? Because the structure says, well, you know what? If you go to select funds, how do you go around selecting them? It's difficult to figure out, because first you got to figure out which theme you want: flexi cap, large cap, mid cap, small cap, and then there are index funds as well. So now you have to select whether you're going passive or active. And if you're going active, which kind of funds, how much do I put in each fund, what kind of SIP do I do, and which fund house should I choose? Should I be diversifying between fund houses? Can I use the same fund house for multiple things? So all these decisions to be made have to be helped. Let's assume that there's a person that needs to help you. There are three kinds of people, and perhaps usefulness wise, they may be in different territories. One is the RIA, who simply says, listen, I will help you buy a direct fund, but I will charge you a fee.
Well, if you can find the RIA, that is.
We'll come to why that model also has incentives that are against it right now. But the second part of this, and the RIA is a very simple model, right? I'll show me your portfolio and say. But you know what happens is, in an RIA, you go to this guy, usually you're 40 years old or 35 years old or something like that, and you say, listen, or let me give you two examples. You're either 20 years old and doing a 10,000 rupee SIP. Now you're doing a 10,000 rupee SIP. How much can you pay the poor guy? I mean, at some point you'll pay him like.
I mean, you're per yourself. I mean, so relatively in this.
Relatively, yeah. So you're like, okay, I'll pay you $1,000. Now the distributor is like, listen, I can handle like 200 customers at max, maybe. So if you're giving me 2,000 rupees upfront, then I have 200 customers is 2 lakh rupees per year. That is less than the per capita income of this country, and it's not a reasonable profession for someone in this space to kind of have to build technology, have all the compliance requirements and so on. But let's say that RIA doesn't.
The guy should probably do it for free and just say, buy these and go away.
Yeah, I mean, and that's what many of the other people kind of did, the websites that kind of doing, but they never give any advice. They just set it up so that you could choose your funds and buy it, but it went into an RIA kind of a model. But what I find in the RIA world is that the more that the rules that are coming in are forcing distributors to take a much more deeper look at compliance, and therefore their costs are going up, right? So you got to have an agreement, you got to understand the customer's risk profile, you got to understand what the customer wants. Now they're going to have to raise their rates. That means that automatically becomes affordable only for people who have money. But then people who have money actually don't come easy, because they will come to you with a khichdi of 70 funds that they have bought over the years, and they will tell you, listen, you need to do something about this, and I'm going to pay you a fee. I say, fantastic. You know what? Your portfolio is worth about 25 lakhs, but or 50 lakhs, and I will take this, I will reformat this, I will sell some funds, I will buy some other funds, I will do this bunch of things. These are the 3 funds you need to just buy from now on, because 3 funds will suit your need for the rest of your life. Fantastic. How much do you charge? Oh, give me 1 lakh rupees. Fine, because you did all this work, right? Or 50,000 rupees or something.
No,
like
2% you can do it for the first year.
First year, or say, or like you said, 1%. Let's do 50,000 rupees, and I charge you that 50,000 rupees. Now I'm charging you that 1%. But it obviously is front-loaded work. It is a lot of work for this customer. Now, I'm hoping that this customer stays with me for 10 years so that I can incrementally get 50,000 rupees a year for 10 years. I have done him work worth 5 lakh rupees, but I know I will be able to charge it only over a period of 10 years. But what happens in year 2 is when you go to him and say, he says, look, what can you help me with today? And you say, well, you know what? I took a look at your funds. Everything's going fine. You don't have to do anything. So the guy looks at you, I have to do nothing? No. Why am I paying you 50,000 rupees then? No, but that's your fee, your annual fee. Because I did all this work last year. That was last year. So now you didn't do anything, bye-bye. So, the thing is, we are naturally programmed to do that. So what does an RIA do as a business? He's like, dude, I can't charge a customer because if I charge him a too high a fee, it doesn't work. And maybe there's some regulations also against it, but he won't pay also, right? But at some level, the work is so front-loaded that the RIA says, listen, I'm not doing it. So RIA businesses registrations have gone from, I think, 1,200 down to 900. When the markets have gone up like 4x, simply because RIAs don't see the potential for being able to now, because they have to take this dwindling revenue so in subsequent years, where they'll charge you 50,000 in the first year, and probably second or third year they won't earn anything. And then they have to do higher compliance requirements, because now the RIA is a more regulated piece of license, where you will actually have a lot of restrictions on how you can communicate with customers. You communicate with customers, with potential customers, with an advertisement. You have to pay the BSC 3,000 rupees to vet the ad, while people on Twitter who are not registered will go around saying anything they want for free. But you're a regulated person, so you have to pay this 3,000 rupees for BSC to look at it and come back and say, okay, you can publish this ad. And because of this regulatory restriction, the RIA now has felt like, listen, and plus I'm getting a customer who's refusing to pay me from year 2 onwards. So I think that effectively causes RIAs to be not. So if I'm an investor, I'm looking at an RIA, I would look at him and say, boss, how are you going to survive? Tell me. Are you going to handle 7,000 customers? Because then you won't give me any attention. So you can handle 200 customers max. How are you earning enough money to be able to sustain yourself? Because if you don't sustain yourself, you'll quit and apply for a job in some random other company, and you will walk away from me. Then where am I left, right? So I want my supplier to be happy. I want my supplier to be profitable. But I'm paying him, but the others are not. And if the average thought process is like that, then RIA business will simply not survive. So I think that is one of the best options, but it is crippled because of behavior, and because of perhaps a layer of regulation that applies to them more meaningfully than it applies to agents of other types. Now, what are the other types? One is the mutual fund distributor. So yeah, you're paying a fee, but you're not paying it out of your pocket. It's coming out of your fund. Here, the guy can do the same amount of work. He can look at your portfolio, he can reorganize, he can say, sell this, buy that, and he does this for you. And then he gets paid 1% per year, because the mutual fund charges 1.5 and pays him 1% per year for the next 10 years, whether you like it or not. You're going to pay for it. Yes, this is also probably on the other extreme, but I think this is still more fair, because the front-loaded task continues. The AUM can actually earn the person income over a longer period of time. For the smaller guys who are doing the 10,000 rupee SIP, this is still sustainable, because the larger guys will come and subsidize the smaller guys, and he'll say, okay, you do a 10,000 rupee SIP now, koi baat nahi. 5 years later, you'll start doing a 50,000 rupee SIP, and then you'll become good. I will subsidize you till then, because I know my fees can keep going up, unlike in a RIA where a fixed fee model kind of applies in most cases. And I think this is a problem, because people keep saying this, that the best thing to do, and I've said it, the best thing to do is to either educate yourself, because the RIA may not have a business model. Isn't the best thing to do is to educate yourself and go direct?
We have Capitalmind Premium for that.
Yes, we have lots of people who do it at Capitalmind Premium also, and it's a great thing. I mean, I've seen this, but there we're talking about numbers in the thousands, and in actual life, you're seeing numbers in the lakhs and the crores that are investing. The last month alone, that was in July, there were 18 lakh new people making SIPs. Wow. That is almost ridiculous in terms of size, versus this 1,000 people that might be on a do-it-yourself model, right? So, and people will sit with FDs, and they will do nothing to themselves. Now,
I've on that, I mean, one of the customers, when I met them first, they had hundreds of crores in FDs, but they still wouldn't bother, because they just didn't trust stock markets.
Yeah, I mean, at some level, they need that hand-holding. And the MF mutual fund distributor, although the fee is higher, he charges it for you. And that's perfectly fine. But now here's the interesting part. There are two kinds of mutual fund distributors. I'll tell you the kind of person that I think is a great distributor to have. A person who will look at you, who will help you reshape your portfolio. He will tell you, listen, I'm getting paid commissions from this, but that is standard, and that's how I'm going to get paid. You're okay with that. That person then helps you structure your portfolio, earns an income out of your SIPs and stuff like that over a period of time, is in business even 10 years later, and is able to help you through this process of building wealth for the longer term, right? Great thing. Guess who isn't that? typical bank relationship managers tend to not be that person. I'll tell you why. Because first of all, they have no incentive to give you great products because they don't even want to know your whole portfolio. Most likely, sir, yes, HDFC Manufacturing Fund has come. Would you be interested? They're not even asking you whether you have a bunch of these things. Is this a thematic fund? Should I be offering you a thematic fund? They're doing none of the sort, and they're not even restricted because SEBI has no restrictions on what kind of advice a mutual fund distributor can give. And effectively, this person who will probably be your RM for only 6 months and therefore has not seen the kind of portfolio, will not have any incentive to see your portfolio grow, will basically be the worst kind of advisor to have. But unfortunately, they're the first point of call for most people, thinking I'll talk to my bank, they'll help me build a portfolio. But the bank actually has zero incentive in your long-term goals. It's after a while that you realize this, and then there's a tax issue for getting out of that fund into something else. But you know that the person in the middle, the mutual fund distributor who's actually in your benefit, this is the guy who will actually hurt, or this is the girl, if just to be gender.
You can be gender neutral when you're criticizing people.
Yes. so but this person, I'm not criticizing them in this point. I'm actually saying that this person will actually hurt if you lose money, if they give you bad advice, because after some time you'll say, listen, I'll take my money out of you and I'll go to somebody else. That person who's trying to build this relationship advice as part of a relationship, that person is actually one of the better persons that kind of help you do things.
So I think the three categories of people you came up with is the vanishingly small number of RIAs and how they have a bit of issues with compliance, and that you're seeing that in the dwindling numbers. The second one is basically distributors, and maybe you thought of it, there's a particular category of that which is distributors who can hopefully help you over a long enough period of time. And on that, one thing we've noticed is that even when I at least speak with customers or from the team, when I've heard, if people have been working with a distributor for several years, and even if the corpus has grown to say, I don't know, a few crores, even though they realize they're paying the distributor maybe a percentage, probably less than that, but they're paying some, they don't seem to grudge that money too much and are actually reasonably keen to keep that relationship alive. They may stop incremental money going to that person, but they don't end that. And I think your third category, I guess you were mentioning, is short-term distributors or people who are basically just selling you things on a one-off basis. So I think this was your three categories of people. At what point would it make sense for you to say that there's enough money here that I should just do this myself?
Well, that's a good question. But before we get there, I think before we get to that point, we should say, okay, maybe there's a point of how do I select a distributor, right? So at that level, let's go down that route and then say there's a point at which maybe going direct makes sense and all that stuff. The numbers are excruciatingly large. Let me just tell you that it's excruciatingly large for a lot of people. Now, a distributor, how do you distinguish between the kind of distributor that is good or that is not so good? It's damn difficult. But here's the thing: then mostly good people in this industry who actually want to help you. In general, you might say that they're trying to revenue maximize, but they want to revenue maximize with a point that says, well, I won't hurt you. I'll give you a product that works for you. Maybe it won't work as best as the best product in the industry, which I don't even know if I can figure out. But you know what? A PPFAS which charges 0.6% has delivered less returns than, say, a quant momentum fund which charges 1%. I'm just saying it's the number of fees. We charge 1%. We've done a 68% in one of our portfolios. Are we worse off than versus a PPF has done only 38% in the last 1 year? That the difference of 30% makes up for our tiny increase in fees, and both of our returns are post fees, right? So when you pay more fees, if you get more returns, isn't that a good thing? Is fees the only delivery mechanism that you should be distinguishing funds by? I think that's the wrong answer. It has to be a combination of performance as well. But and
type, right? Because someone may be very much at peace with PPFS giving, if it was 38, it was 38, and not at peace with the quant giving whatever 92, whatever they gave because of various issues. So I do understand the difference.
So because now you've got a distributor in the middle, that person has to make that distinction. That person has to probably look at you and say, listen, there's a core portfolio of funds which I think you should just be comfortable with for a long time. These are not extraordinary funds. They're just good funds that that you will continue to invest in. I won't make any changes in them for a long time. Maybe 80-90% of your portfolio is that, and 10% of your, and this is now spread across, right? You got to better balance thali. You can't just have a masala dosa. You're going to have a little bit. I mean, because you can't have it, vegetable, and you got to have protein and bunch of things and all that stuff, and of course coffee. But the point about getting one step further is to say the distributor is giving you all of these different classes in some kind of core portfolio, and then he's saying, listen, 10% of your money you got to play out with, and that play around with is maybe the thematics. We'll do defense today, we'll switch out of defense and go to manufacturing tomorrow, we'll switch out of manufacturing and go into pharma. So this is a call the distributor is helping you take, saying this is a satellite portfolio. The satellite portfolio is going to be aggressive, but it's only 10% of your overall portfolio. The core is a distribution of large, mid and small cap funds, which we will continue to invest in every month on the same basis. So this might be one way for you to figure out if your distributor is telling the right things. This person, even if he sells you a thematic fund, you know he's telling or she's telling you about this fund in a thematic concept in their satellite portfolio, which tends to be more churn oriented, and you're fine with that. Now, this could also be, for instance, a person who mixes your work along with other stuff. Because mutual funds are not the end of the world. You probably have real estate. You probably have insurance policies. You have PF or PPF or EPF or whatever it is that has to be kind of tabulated in one place. You have FDs in a bunch of banks. You have a family portfolio that needs to be managed, some of whom don't have any mutual funds at all. So somebody is actually helping you build this together. It may be a CA, it may be a CFA, a person who's handling your financial life. Mutual funds are only one part of it. The fees that you pay them is not only for the mutual funds. You're paying them for a bunch of other stuff. Some of these people can actually succeed very well as RIAs as well. Well, let's say I'm going to charge you a fee because I'm not going to do the real estate work for free and nobody's paying me for that. So you're going to pay me a fee anyways. I'll do the RIA work for you. So that could be that person, but mostly it's the mutual fund distributor for the smaller person who does not have all these various asset classes. That tends to be the most useful hand-holding person that you can take through the time when you don't want to delve deeper and figure it out. But like you said, after some time, you start looking at this and saying, Deepak, I have 5 crores. Now I'm paying 5 lakhs a year. This is high. I won't grudge him that. But there must be a point of switch, right? Now, let me say, you're going to need to hire a person who understands this stuff to do the direct stuff for you. Because nobody's going to work for free. You don't want a distributor because you're paying him too much. According to your head, you're paying him too much.
But unless they're doing other things for you, which again is a separate point.
But let's say that the person that you want to hire, you want to hire them for whatever reason, and that person costs you maybe 1 lakh a month plus establishment expenses of another 40,000-50,000 a month. So 18 lakhs a year. So to offset 18 lakhs a year of expense, you're going to need a 20 crore portfolio. Maybe you can say, Deepak, I have 4 friends and together all of us will put in our 5 crores each and will be 25 crores. And therefore this person we can hire and do this. Fine, great, fantastic. But guess what? Most advisory work is very boring. You look at person's portfolio once, you made decisions for them for the next full year. What does this person do? He's not going to sit there bored out of his wits doing nothing. Because at some people need more motivation to live their lives. You're not allowing him to do anything else because he's hired by you and doing things. You might say, oh, advise other people. In which case he's an advisor or he's a mutual fund distributor by himself. Then what's the difference? So I would say going down this route of saying I'll go direct without taking the effort to learn it yourself is going to need you to have some 20 or 25 crores of portfolio assets before you can actually say that, listen, I'll just go direct and I won't bother about it. There's somebody else who's looking at all of this stuff. Otherwise, you're going to need a helper, a distributor, an advisor or something like that.
One thing, in all the years you've been working with Capitalmind, I guess mostly premium customers, but even PMS customers, have you found people who've successfully made the transition from they spent phase 1 of their career getting from 0 to 25 crores or some large number like that, and then actually migrate to a phase 2 where they'll now be like, now I'm going to manage this and it goes well?
So, very interesting. I've seen both types. Okay. So I've seen the guys who earned this money and said, dude, I have earned it. It is over. I am done. I don't want to deal with this for the rest of my life in terms of having to make decisions every day on which fund to buy. I don't want this, and I'm willing to pay literally almost, even if it's unreasonable, an amount for somebody to manage it for me. So we charge a much lower fee for our say a mutual fund managed portfolios, right? So like looking at us and saying we charge 0.25%, let's say.
They're like, just take it.
Well, that's a no-brainer, because so what if it's 10 crores, 0.25% is still 2.5 lakhs. But for 10 crores, 2.5 lakhs is nothing, because you're not going to be able to hire anybody to do this for you for 20,000 a month. So they're okay with that. But there are others who, as soon as they get into the kind of money that they have, they suddenly think, or maybe rightfully so, because they've earned the money, they want to be much closer to their money. This is when they find the biggest problems in the world, which is that there is no reasonable software that exists that actually encapsulates so many asset classes, from gold to real estate to FD to things like that. There is, of course, M-Profit in India. It's a pretty good software, but it's still painful to enter data into and manage. It doesn't automatically get feeds and so on. Then on top of that, now you have to analyze the stocks that you've bought on a regular basis. Some news comes in, and for some people it's okay because they're doing this on a regular basis. It's very exciting and all that. But a lot of people who go down this route come out of it and say, I think this is a bit too much for me. I thought I mean, I know I can be good at it if I want because I'm smart, but this simply does not excite me. It's like me saying, oh, I could milk a cow and drink the best milk. I'm like, I don't care. Even if I have to pay 100 people for it, even yes, if I'm capable of it and if I could be the best person doing this job, it doesn't matter. It's not going to change my life. I would rather live my life doing more meaningful things to me. And therefore, I'm willing to outsource this. Nobody goes, when I was younger, my mom used to take me to this place where you should take these things and you have to put them in this mill, the flour mill, and then get that powdery stuff that comes out into a bag. And
was this for character development? Or
at some point, I don't know why, it was popular. So you had this machine where you put some stuff on top.
It was fun, actually.
It was, yeah. I liked it for this thing, but it was very, there was a lot of dust, and you had to put your handkerchief around your nose while you were filling that stuff. Nobody does that anymore, because you just buy pre-packaged flour. Why are you going to go to a flour mill to do this stuff? So at some point you evolve and you say, well, I'm rich enough to outsource this, even if it costs money. Yes, I'll pay 5 rupees more per kg of flour compared to earlier, but I can afford that 5 rupees. That same mentality has to come here and say, well, the distributor is going to cost me so much, but you know what? If I manage my own money, I'd probably end up with some 8 or 9% a year, because I don't know what the hell I'm doing. If this guy does it, he'll give me 13% a year after his fees, most likely. So I'd rather choose that person, because why am I doing this and putting so much effort and charging myself no money for my own effort?
Point is well taken. I'd like to come back to where we started today's podcast episode, which is, so there are a bunch of NFOs coming out. And in general, when you see a whole bunch of NFOs coming out, mostly thematic funds or mutual fund houses filling out the gaps in their product portfolio, do you personally find this interesting? Do people come to you either on Twitter or in real life and ask you for advice on whether to subscribe to these NFOs or not? Where do you stand on these?
There are 3 phases of it. The first thing is that people don't know there are no such funds coming out, because that's a bear market and nobody cares. So the bull market starts, people start making these thematic funds. The first set of funds are spectacularly successful. People are then asking questions on, should I invest in this fund? And mostly I'm like, listen, if you've got a satellite portfolio, maybe you should get yourself a proper advisor who'll kind of build a portfolio level layer for you, whether it's a distributor or an advisor. And then you'll be able to kind of determine whether this fits into your mix or not. The third phase, which is the most scary, is when people call you and say they have never invested in stocks or mutual funds meaningfully, in terms of, they've always been trying to take advice from you. They call you and say, Deepak, you should buy this NFO. And that is when I know that you've reached one extreme in the market, and maybe we're getting there soon enough, because if this podcast is popular, then we might find out that that's true. But in the end, such NFOs, we all know, are out there to make money from a bull market and allow the AMC to spend more, not earn more. They will earn more, but they will spend a lot more than they earn. I mean, to earn that money. I think that is the core driving force for new NFOs. If we recognize that, we will not pay them too much attention. But because it's a bull market, we have to pay everything attention. And when you pay them too much attention is when perhaps things get to an extreme. So I think 2 months ago, there was a manufacturing fund NFO that gathered 10,000 crores. Yes, a month back, there was another business cycle fund, I think, that got 1,800 crores with almost no advertising at all. 1,800 crores is a lot of money. It took us 6 years to develop 1,800 crores in AUM in the PMS. But a mutual fund was able to just do it like that just by having an NFO. I think it's remarkable that this is happening today, but it's also remarkable that things never change, because it happened in 2006 and 2007. It took 1.5 years before that bubble kind of burst. You can never say that say today or tomorrow or 6 months down the line. I can't say when it will break, but it's building up towards it. And I think you will find a point at which there is no NFOs. All of these NFOs that have been just created eventually will merge with each other, because once they lose AUM to a point where they're too small to manage, the AMCs merge them back. And then anyway, by that time, the AUM is so small that no distributor cares about the commission they're getting on this. So it becomes a smaller part of the universe. So that's the cycle. That's really the mutual fund cycle of the business cycle of things. So it's exciting, I think, from an angle of this, but we have to recognize that this is a byproduct of the industry.
Right. So make the most of the bull market, but don't get carried away. Thanks, Deepak. Well, everyone, thanks for listening. To hear more episodes, visit us at capitalmind.in/podcast. And if you have more than 50 lakh rupees and are looking to invest it, then do visit our PMS service at capitalmind.in to see what we have on offer. Till next time.